Welcome back to the Deep Dive. We're here to break down complex ideas, make them clear, make them stick. And today, wow, we're tackling something absolutely fundamental. It's like the financial skeleton of, well, pretty much every business out there. Ever find yourself wondering how companies actually pay for everything? The big projects, the new tech, even just keeping the lights on day to day.
It's a great question, and it leads us straight into today's topic.
Exactly. Our mission for this deep dive is to really get under the hood of what's called capital structure. It sounds maybe a bit intimidating, but honestly, it's core stuff. It dictates how a business gets its money, and that affects, well, everything. Daily operations, long-term growth plans, even how much risk it's taking on.
Hmm.
So our goal here is simple. Untangle this financial jargon, make it clear, make it compelling, maybe even actionable for you. We're drawing on some really solid material to give you the inside track.
And it's so important to grasp because, as you said, it's not just some line item on a report. It's really the financial DNA. Understanding a company's capital structure gives you this incredible lens into its financial health, its big strategic bets,
Yeah.
and crucially, how it plans to grow, make money, and handle risk. It's foundational.
Okay, so let's dive right in. Foundational concept. What is capital structure exactly? At its heart, it's really just the mix, right? The combination of different types of money a company uses to operate and hopefully grow.
That's it. And the main ingredients in that mix, it really boils down to two key things:
Mhm.
debt and equity.
Right. So debt, that's the borrowed money. Stuff you have to pay back, usually with interest, on a set schedule.
Yep. And companies sometimes like it because you get the cash without giving up ownership.
But you absolutely have to make those payments. No getting around it. That's the risk.
Exactly. Then there's the other side, equity.
Equity. So this is where the company sells off little pieces of its self-ownership shares.
Precisely. You raise money, but you don't have that strict repayment schedule like a loan.
Instead, the people buying those shares, the shareholders, they become owners. They get a piece of the future profits, often voting rights.
A say in how things are run.
Yeah, we could maybe use an analogy, like buying a house.
Perfect. Go for it.
Okay, so you could get a mortgage from the bank, that's your debt, fixed payments, interest, the whole deal.
Mm-hmm.
Or maybe you get some money from family, and they now kind of own a part of the house with you. That's like your equity.
That's a great way to put it. And just like with a house, most companies don't rely on just one or the other.
Right. They use a mix, a strategic blend of both debt and equity.
And understanding that mix, that choice between borrowing and selling ownership, that's really the key. It shapes everything. Risk, strategy, the whole 9 yards.
So let's dig into debt first. You mentioned it's not just one thing.
Oh, definitely not. It's a whole spectrum. We usually break it down into short-term debt stuff due
Yeah.
within a year and long-term debt, which stretches out further.
Okay, so short term first. What are we talking about there? Like for everyday cash needs.
Exactly. You've got things like short-term notes payable. Think of them as quick bank loans, often for working capital, managing the day-to-day ebb and flow of cash.
Right.
Then there's commercial paper. This is interesting. It's basically an IOU from a large corporation, but it's unsecured. Very short term, usually 270 days or less.
Okay. Unsecured. So riskier for the lender.
A bit, yeah, which is why usually only large, reputable companies can issue it easily. It's used for really immediate needs, like buying inventory or bridging a short gap until payments come in.
Makes sense. Any others?
Yeah, another really common one is line of credit. The bank pre-approves a borrowing limit, and the company can draw funds as needed up to that limit. It offers a lot of flexibility for managing those short-term cash fluctuations.
Gotcha. Okay, so that covers the quick stuff. What about the big long-term investments? Building factories, major expansions.
Right, that's where long-term debt comes in. You've got your standard long-term notes payable, just bank loans stretched over several years. Simple enough,
Okay.
but then it gets more varied. You hear about debentures, right?
Vaguely. Bonds, aren't they?
Exactly. They're bonds, but the key is they're unsecured. They aren't backed by any specific asset the company owns.
Ah. So if the company goes belly up.
Debenture holders are still creditors, so they get paid before shareholders, for sure. But they can't point to a specific building or piece of equipment and say, that's mine.
Okay. What about, I think I saw something called subordinated debentures. Sounds even riskier.
You got it. Subordinated means they rank lower than other senior debt holders in a liquidation.
So they get paid after the other lenders.
Correct. If the company fails, they might get less back, or even nothing if the assets run out before reaching them.
Wow. So why would anyone buy those?
Higher interest rates. To compensate for that extra risk, Companies have to offer a much better return. It's always that risk-return trade-off.
Always comes back to that, doesn't it?
It really does. And the variety continues. Ever heard of income bonds?
I'd say I have.
They're fascinating. They only pay interest if the company actually hits certain predefined income levels.
Really? So if the company has a bad year, no interest payment.
Exactly. Less pressure on the company in tough times, but obviously less appealing for investors who want that predictable income stream.
I can see that. Okay, what about the infamous junk bonds? Everyone's heard that term.
Ah, yes, junk bonds. The term itself tells you something. Technically, they're called non-investment grade bonds.
Meaning high risk of default.
Very high risk, yes. These are issued by companies that maybe aren't as financially strong or are already quite leveraged.
So again, why buy them?
Massive potential returns. To convince investors to take on that significant default risk, these bonds have to offer really high interest rates, much higher than safer bonds.
So it really comes down to the investor's risk tolerance and the company's situation, I suppose.
Absolutely. And then on the safer end, you have things like mortgage bonds.
Okay, that sounds more familiar. Secured by property.
Exactly. They're backed by specific real assets, like buildings or land or pools of mortgages. Bondholders have a legal claim, a lien on those assets.
So if the company defaults,
The bond trustee can seize and sell those specific assets to pay back the bondholders, much safer for the lender.
which means lower interest rates for the company, presumably?
Generally, yes. Lower risk equals lower cost. And finally, we should mention leases.
Leases, like renting equipment or office space, how is that debt?
Well, it's treated very similarly from an accounting and financial perspective now, especially long-term leases. It's a contractual agreement to use an asset for periodic payments. The company using the asset, the lessee, actually records it on their balance sheet. They put down a right-of-use asset and a corresponding lease liability.
So it shows up like debt.
Essentially, yes. It reflects the obligation to make future payments. And on the income statement, it depends. Operating leases might just show lease expense, but finance leases, which are more like buying the asset over time, will show separate interest expense and amortization expense.
Huh. So even renting can look like debt on the books. Good to know.
It reflects the economic reality of the commitment.
Okay, that's a fantastic tour through the world of debt. So many flavors. Now, how does the other side, equity, compare? What are the big mental shifts we need when thinking about selling ownership instead of borrowing?
The biggest shift is probably the claim on assets and the nature of the return.
Right. So equity financing, we said, means issuing stock actual ownership pieces. And the absolute key thing, especially if things go wrong,
Is that shareholders are at the bottom of the priority list in bankruptcy.
dead last, after every single type of debt holder, secured or unsecured.
Correct. They get the potential upside if the company booms, but they bear the most risk if it busts.
Makes sense. So within equity, are there different types, like with debt?
There are primarily two main types you'll encounter: preferred stock and common stock.
Okay, preferred stock first. I've heard it called a hybrid. What does that mean?
It really does blend features of both debt and equity, which makes it unique. Like debt, it often pays a fixed dividend amount. Predictable income, similar to interest.
Okay, so that's the debt-like part. What's the equity part?
The equity part is that these dividend payments are usually not mandatory. The company's board of directors typically has discretion.
Ah, so if times are tough, they can decide not to pay the preferred dividend, unlike bond interest, which they have to pay.
Exactly. That gives the company flexibility. But here's a huge difference from debt for the company. Those preferred dividends are not tax deductible.
Ooh, okay, so no tax shield like you get with interest payments on debt.
Right. So preferred stock is less risky than debt in terms of forcing bankruptcy, but it's more expensive from an after-tax perspective because you lose that tax benefit.
Interesting trade-off. Okay, what about the other type, common stock?
Common stock is, well, the most common form of equity. It represents basic ownership.
And this is the one that usually comes with voting rights.
Typically, yes. Common shareholders get to vote on major company decisions, elect the board of directors.
Yeah.
They have a real say in the company's direction. That's a key feature of ownership.
And dividends for common stock.
Totally optional. And they can fluctuate a lot. Depends entirely on the company's profitability and what the board decides to do with the earnings. Could be a lot, could be nothing.
Right. And when a company first sells common stock, how does that show up on the books? I remember something about par value.
Yeah, it's a bit of an accounting detail, but basically the cash the company receives is split. A nominal amount, the par value, goes into the common stock account itself. Anything received above that par value goes into a separate account, usually called additional paid-in capital, or APIC.
Got it. And just to hammer it home one last time, common shareholders in liquidation.
Bottom of the ladder. Absolutely last. High potential reward, but also the highest risk if the company fails.
It really crystallizes the difference, doesn't it?
It does. And seeing all these options, you can understand why companies spend so much time figuring out the right mix.
Oh.
It's not just throwing darts at a board. It's deeply strategic.
Yeah. Maybe we can summarize those key differences, like a quick cheat sheet comparing debt and equity.
Absolutely.
Yeah.
Let's hit the main past key differences, thinking about the practical impact. First up, flexibility. Debt often comes with strings attached to those loan covenants we mentioned, restricting what a company can do. Plus, fixed payments demand steady cash flow. Equity, generally much more flexible, fewer rules, no mandatory payments unless dividends are declared.
Okay, flexibility goes to equity. What's next?
Tax deductibility.
Yeah.
This is huge. Interest paid on debt. Tax deductible. Reduces the company's taxable income, which lowers its tax bill. Dividends paid on equity, not tax deductible at all.
Big advantage for debt there from a cost perspective.
Massive advantage, especially for profitable companies. Okay, third, EPS dilution. EPS is earnings per share. When you issue new shares of common stock, you increase the total number of shares. So even if profits stay the same, the profit per share goes down. Existing shareholders get diluted.
And debt doesn't do that.
Nope. Taking on debt doesn't change the number of ownership shares. So no EPS dilution from debt itself. Advantage, debt, in terms of protecting existing shareholders' slice of the pie.
Okay, good point. What else?
Increased financial risk. This one's critical. Debt means fixed, mandatory payments. Miss them, and you could face default, even bankruptcy. That's significant financial risk. Equity, specifically common equity dividends, are optional. Less risk of financial distress from equity.
So risk is higher with debt. Makes sense.
Definitely. Fifth, issuance costs. How much does it actually cost to get the money in the door? Generally, it's cheaper and faster to issue debt like bonds than it is to issue new stock.
Really? Why is that?
Stock offerings often involve more regulatory hurdles, more complex marketing, higher underwriting fees. Debt issuance can be simpler, especially for established companies.
Okay, so issuance costs tend to favor debt. Last one.
Investor return. How do the investors get paid back? Debt holders typically get a fixed return, their interest payments, and then their principal back. Pretty predictable. Equity holders. Their return is variable. It depends on dividends, which can change, and the stock price going up.
So potentially unlimited upside with equity, but also more uncertainty.
Exactly. Fixed and safer for debt investors, variable and potentially much higher or lower for equity investors.
Wow. Seeing it laid out like that really highlights the trade-offs. Cost, risk, control, flexibility. It's all intertwined.
Precisely. And companies are constantly juggling these factors to find the right balance for their specific situation.
Okay, so we know the building blocks, debt and equity, and their pros and cons. How do companies figure out the cost of this mix? That brings us to WACC, right? Weighted average cost of capital.
That's the one, WACC.
What is it, fundamentally, and why is it such a big deal?
Fundamentally, WACC is exactly what it sounds like. It's the average cost the company pays for all the capital it uses, the debt, the preferred stock, the common equity, rated by how much of each it uses.
So it's the blended cost of all their financing ingredients.
Perfectly put. And why it matters so much. It's the main link between how a company finances itself and its overall value.
And internally, for managers making decisions.
Internally, WACC becomes the benchmark. It's often used as the hurdle rate.
Hurdle rate, meaning?
Meaning any new investment project the company considers building a new plant, launching a product, needs to promise a return higher than the WACC.
Ah, because if the return is lower than the WACC?
The project isn't even covering the cost of the money used to fund it. It would actually destroy value for the shareholders. WACC is the minimum acceptable return.
That makes total sense. It forces discipline.
Absolutely.
Yeah.
And this leads to a key goal in finance, finding the mix of debt and equity that results in the lowest possible WACC. Because that lowest cost of capital translates directly into the highest possible value for the company. That's the sweet spot everyone's aiming for.
The holy grail of capital structure. Okay, so how do we actually calculate this thing? Is there a formula?
There is. But before we show the formula, let's just think about it conceptually again. It's a weighted average. You take the cost of each type of capital, the interest rate on debt after taxes, the dividend rate on preferred stock, the expected return on common stock, and you multiply each cost by its proportion in the company's total funding mix.
So if debt is 30% of the capital, you multiply the cost of debt by 30%.
Exactly. And you do that for each piece, debt, preferred stock, common stock, and then you add those weighted costs together. That sum is your WACC.
Okay, that makes sense conceptually. What does the actual formula look like?
All right, the standard formula is WACC, EV, RE plus, PV, RP plus, DV, R2O.
Whoa. Okay, let's break that down. E, P, and D.
E is the market value of the company's common stock equity. P is the market value of preferred stock. D is the market value of its debt. And crucially, we try to use market values here, not just book values if they're available. They better reflect the current reality.
Okay, E, P, D are market values. What's V?
V is just the total market value of all three combined. So V equals E plus P plus D. It represents the total pool of capital.
Got it. So EV is just the percentage of common equity in the mix.
Precisely. It's the weight. And R is the required rate of return, or the cost of that common equity.
Okay. And similarly, PV is the weight of preferred stock, and RP is its cost.
You got it. And DV is the weight of debt, and R is the pre-tax cost of that debt, the interest rate.
Pre-tax. And that's where the 1T comes in.
Exactly. T is the corporate tax rate. Multiplying the cost of debt by 1P gives us the after-tax cost of debt, reflecting that important tax shield we talked about.
So each term in the formula is just the weight of that capital component multiplied by its relevant cost, with debt getting that special tax adjustment.
That's it. You sum them up, and boom, you've got your weighted average cost of capital.
Okay, theory is one thing. Let's try putting some numbers on this. Can we walk through an example?
Absolutely. Let's take XYZ company. Let's say we estimate their cost of common stock, RE is 8.4%. Their cost of preferred stock, RE, is 6.8%. And the average interest rate on their debt, RD, is 6.0%.
All right, costs are 8.4%, 6.8%, and 6.0%. What about the weights? How much of each do they use?
Good question. Let's use market values. Suppose common stock makes up 55% of their total capital, so EV equals 0.55. Preferred stock is 20%, PV equals 0.20. And debt makes up the remaining 25%, DV equals 0.25.
Okay, 55% common, 20% preferred, 25% debt. Adds up to 100%. What about taxes?
Let's say the corporate tax rate T is 30%.
All right, we have all the pieces. How do we calculate XYZ's WACC? What's step one?
Step one, and it's crucial, is to find the after-tax cost of debt.
Right, because of the tax shield.
Exactly. So we take the pre-tax cost of debt, which is 6.0%, and multiply it by 1 minus the tax rate, so 1.30, which is 0.70.
So 6.0% times 0.70, that's 4.2%.
Correct. The effective cost of their debt, after considering taxes, is only 4.2%. See how much lower it is than the 6% interest rate?
Yeah, that tax shield makes a big difference. Okay, step two, plug everything into the WACC formula.
Yep, now we just plug and chug. WACC equals weight of equity, cost of equity, plus weighted preferred cost of preferred, plus weight of debt after-tax cost of debt.
Okay, so that's 55%, 8.4%, plus 20%, 6.8%, plus 25%, 4.2%.
Let's do the math. 0.55.084 is 0.0462, 0.20.068 is 0.0136, and 0.25.042 is 0.0105.
Okay, add those up. 0.0462 plus 0.0136 plus 0.0705. That equals 0.0703.
Or 7.03%. That's any new project they're considering investing in needs to be expected to generate a return higher than 7.03%.
If it's lower, it's destroying value. If it's higher, it's creating value.
That's the benchmark. It sets the minimum bar for profitable growth.
Okay, that example really helps solidify it. Now, can we dig a bit deeper into how we get the costs for each of those components, like the cost of debt, preferred, and especially common equity?
Absolutely. Each one has its own nuances. Let's start with the components included in WACC. We generally focus on the long-term financing sources: long-term debt, preferred stock, common stock, and also retained earnings, which represent equity reinvested in the business.
Okay, what about short-term stuff?
Some short-term interest-bearing debt, like notes payable to a bank, is often included. But many other current liabilities, like accounts payable, money owed to suppliers, or accrued expenses, like wages owed but not yet paid, those are usually excluded.
Why exclude things like accounts payable?
Because they're often considered free sources of financing. Your suppliers give you maybe 30 days to pay. During that time, you're using their money without paying explicit interest. So they don't have a direct cost component in the WACC calculation itself.
Got it. Focuses on capital that has an explicit cost.
Yeah.
And always after tax, right? Especially for debt.
Yes, always think in after-tax cash flows. That's what matters to the company. And as we saw, the cost of debt is the prime example. We calculate the weighted average cost of debt, focusing purely on the after-tax cost of raising funds through borrowing.
So the pre-tax cost is just the stated interest rate.
Right. And the after-tax cost is that pre-tax rate times one tax rate.
Let's do another quick debt example just to be sure. Say pre-tax cost is 12.5%, tax rate is 30%.
Okay. After-tax cost equals 12.5%. 1.30 equals 12.5%, 0.70.
Which is 8.75%.
Exactly. A significant reduction from 12.5%. And this highlights something interesting. The higher the tax rate, the bigger the benefit of debt financing becomes, because that tax shield is worth more.
So higher taxes actually incentivize using more debt.
From a purely cost perspective, yes. Debt often ends up being the cheapest form of capital on an after-tax basis because of this.
Okay, that's clear for debt. What about the cost of preferred stock? You said it was simpler.
Much simpler in calculation. It's basically just the dividend paid to preferred stockholders divided by the net amount the company received when it issued the stock.
And no tax adjustment here.
None at all. Because remember, dividends paid out are not tax deductible for the company. So the stated dividend yield is pretty close to the actual cost.
Okay, so the formula is annual preferred dividend net proceeds from issuance.
Exactly. And net proceeds means the cash received after paying any flotation costs.
Flotation costs, what are those?
They're the costs of issuing the security investment banking fees, legal fees, printing costs, things like that. They reduce the amount of cash the company actually gets to keep in use.
So they effectively increase the percentage cost of the capital raised.
Precisely. Let's run through that preferred stock example again. 10% dividend rate, $100 par value, but $5 flotation cost per share.
Okay. Annual dividend is 10% of $100, so $10.
Right. And the net proceeds are $100 issue price minus $5 flotation cost, so $95.
So the cost is $10 dividend, $95 net proceeds.
Which comes out to about 10.53%. See how the flotation cost bumped it up from the nominal 10% rate?
Yeah, it's higher. Okay, preferred stock seems manageable. Now the tricky one. Cost of retained earnings or common equity. How do you cost money the company already has?
That's the million-dollar question.
Right.
And you're right, retained earnings profits the company kept instead of paying out as dividends seem free, but they absolutely have a cost. It's an opportunity cost.
Opportunity cost, meaning what the shareholders could have earned elsewhere.
Exactly. The company must earn a return on those reinvested earnings that's at least as good as what its common stockholders could have achieved by investing that money themselves in something of comparable risk.
If the company earns less, it's actually hurting shareholder value, even using its own money.
Precisely. And like preferred stock, no tax adjustment here because dividends aren't deductible anyway. Now, figuring out this opportunity cost isn't straightforward. There are three common methods.
Okay, what's the first one?
The first, and probably most widely used in practice, is the capital asset pricing model, or CAPM.
CAPM. Heard of it. What's the idea?
The idea is the cost of equity equals the return you'd get on a totally risk-free investment, plus a premium to compensate for the specific risk of holding that particular company's stock.
Risk-free rate plus a risk premium. How is the risk premium calculated?
It uses the stock's beta. Beta measures how volatile the stock price is compared to the overall market. A beta of 1 moves with the market, higher than 1 is more volatile, lower is less.
Okay.
The risk premium is the stock's beta multiplied by the difference between the expected return of the overall market and the risk-free rate. That difference is the market risk premium.
Got it. So formula, risk-free rate plus beta market return risk-free rate.
You nailed it. Let's try an example. Say beta is 1.25, risk-free rate is 8.75%, expected market return is 14.25%.
The market risk premium part is 14.25%, 8.75%.
The market risk premium part is 14.25%, 8.75%. Multiply that by the beta of 1.25.
1.25, 5.5%, 5.5%, both 6.875%.
Right. Now add that to the risk-free rate, 8.75% plus 6.875%.
Equals 15.625%, or let's say 15.63%. That's the cost of equity using CAPM.
Exactly. The higher beta means investors demand a higher return for the extra volatility.
Makes sense. What's the second method?
The second is the discounted cash flow, or DCF, method.
DCF, usually used for valuing stocks, right?
It is, but we can rearrange the logic to estimate the cost of equity. It's based on the idea that a stock's price reflects the present value of all its expected future dividends.
Okay.
So, if we know the current stock price, the expected dividend next year, and the expected constant growth rate of those dividends, we can solve for the implied required return, which is our cost of equity.
How does the formula look?
Cost of equity, expected dividend next year, current stock price, plus dividend growth rate, or D1 P0 plus G.
Okay, D1 over P0 plus G. Let's use that example from earlier. Dividend just paid was $2. Growth rate G is 7.5%. Current price P0 is $25.25.
First, we need D1, the dividend expected next year. That's $2, 1 plus 7.5%
Yeah.
for $2.15.
Right, so RE with $2.25.25 plus 7.5%.
Okay, $2.15 divided by $25.25 is about 0.0851 or 8.51%.
Add the growth rate. 8.51% plus 7.5% plus 7.5% to 16.01%.
So the DCF method gives us a cost of equity of 16.01%, a little different from CPM's 15.63%.
Interesting. Okay, what's the third method?
The third one is the bond yield plus risk premium, or BYRP method.
Bond yield plus risk premium sounds intuitive.
It's the simplest conceptually. It starts with the basic idea that owning a company's stock is riskier than owning its bonds.
Makes sense. Equity holders are last in line.
Exactly. So the required return on equity must be higher than the yield on the company's own long-term debt. The BYRP method estimates the cost of equity by taking the company's pre-tax cost of long-term debt and simply adding a subjective risk premium.
Subjective, so it's a bit of an estimate.
It is. The premium is meant to capture the extra risk of equity over debt for that specific company or industry. It's often based on historical differences or analyst judgment.
Okay, example. Let's say the company's long-term bonds yield 11.34%, and analysts estimate the appropriate equity risk premium over that is 4.5%.
Simple addition here. Cost of equity equals 11.34% plus 4.5%.
That's 15.84%.
Right, so now we have three estimates. CAPM gave 15.63%, DCF gave 16.01%, and BYRP gave 15.84%.
They're all in the same ballpark, but not identical. What do companies do in practice?
That's the art part. If the methods give reasonably close results, they might average them or pick the one they feel is most reliable for their situation. If the results are wildly different, it signals a need to re-examine the inputs and assumptions. It highlights that estimating the cost of equity isn't perfectly precise.
Fascinating. Okay, so we can estimate the costs, we know how to weight them. Now back to the big picture. Finding that optimal capital structure, the one with the lowest WACC.
That's the target. Lowest WACC equals maximum firm value.
And it's a balancing act, right? You said just piling on cheap debt isn't the answer because risk increases.
Exactly. It's a trade-off. Imagine that graph we talked about.
Right.
As you add more debt initially, the WACC likely falls because debt is cheaper after tax.
Right, the tax shield helps.
But as the debt level keeps rising, both lenders and equity investors start getting nervous. Lenders demand higher interest rates, cost of debt goes up, and shareholders demand a higher return on their equity. Cost of equity goes up because the company's financial risk is increasing.
So eventually, those rising costs of debt and equity start to outweigh the tax benefit of the debt.
Precisely. The WACC curve hits a bottom point, the minimum WACC, and then starts to curve back upwards as the company becomes over-leveraged and perceived as too risky.
And that lowest point on the curve, that's the theoretical optimal capital structure.
That's the sweet spot, theoretically. In the example from our source material, that minimum WACC occurred at a debt-to-equity ratio of 4.0. Finding that exact point in the real world is tough, of course.
Yeah, markets change, conditions change. It must be a constant evaluation process.
It really is. It's not a set-it-and-forget-it calculation.
And how does this optimal structure idea tie back into making investment decisions, capital budgeting?
It's central. Ideally, when a company takes on a new project, it should fund it in proportions that maintain its target optimal capital structure. And, as we said, the project's expected return must beat the company's overall WACC.
But is it always okay to use the company's overall WACC for every new project?
That's a fantastic and critical question. The answer is not necessarily.
Oh, why not?
Think about it. The company's current WACC reflects the average risk of its existing assets and operations. What if the new project is significantly riskier or safer than the company's typical business?
Like a stable utility company deciding to invest in a speculative biotech venture.
Exactly. Using the utility's low WACC to evaluate that risky biotech project would be misleading. It wouldn't adequately account for the project's higher intrinsic risk. The hurdle rate should reflect the project's specific risk.
So you might need to adjust the WACC or use a different hurdle rate altogether for projects with different risk profiles.
That's the best practice. You really should evaluate the project based on the cost of capital appropriate for that project's risk level, considering how it might change the company's overall leverage and risk profile. Think about the cost of the next dollar of capital needed for that specific investment.
That adds another layer of complexity, but it makes sense. One size doesn't fit all.
It rarely does in finance.
Okay, we've spent a lot of time on the financing side, capital structure. What about the other side of the balance sheet? The assets. Is there a connection?
Absolutely, there's a strong interplay. We talk about asset structure, which is simply the mix of assets a company holds, how much is current versus non-current.
Current assets being things like cash, inventory, receivables, stuff expected to turn into cash within a year.
Right. And non-current assets are the long-term ones. Property, plant, equipment, PP&E, intangible assets like patents, long-term investments, things providing benefits over multiple years.
So how does the mix of assets connect to the mix of financing?
Well, think about how capital structure decisions impact assets. When a company raises debt or equity, what does it get immediately?
Cash, a current asset.
Right. And what might it use that cash for? Often, to buy long-term assets, build a factory, PP&E, conduct R&D, leading to intangibles. So capital structure choices directly fund the asset structure.
And does it work the other way? Does the asset structure influence financing?
It does. The nature of the assets can influence the type of financing available or appropriate. Companies with lots of tangible, long-lived assets, like real estate or heavy machinery, might find it easier to secure long-term asset-backed debt, like mortgage bonds.
Because they have good collateral.
Exactly. And also, the cash flow generated by those assets is needed to service the debt taken on. You need sufficient current assets, especially cash, to make those interest and principal payments that arise from your capital structure choices. So they're deeply interconnected.
That makes sense. Now, speaking of debt payments, you mentioned loan covenants earlier, the rules lenders impose. How does the company's capital structure affect those rules?
It has a huge influence. Covenants are all about protecting the lender's investment.
Right, guardrails for the borrower.
Think about two extremes. Company A is financed mostly with equity, very little debt, low financial leverage.
Okay, not many fixed debt payments to worry about.
Right. From lender's perspective, Company A looks pretty safe. The risk of default seems low, so the covenants in their loan agreements will likely be less stringent, easier to meet, fewer restrictions.
Okay, now, Company B. Lots of debt relative to equity, high financial leverage.
Now the lender sees more risk. Company B has significant fixed interest payments it must make. If earnings dip, default is a real possibility.
So the lender will want more protection.
Exactly. Loan covenants for Company B will almost certainly be more numerous and more restrictive.
Yeah.
They might limit further borrowing, restrict dividend payments, require certain financial ratios to be maintained. Basically, more rules to monitor the risk and protect the lender.
So the cheaper cost of debt often comes bundled with more operational restrictions. Another trade-off.
It's always a trade-off. More debt usually means less wiggle room.
Oh, okay. Beyond the structure itself, what everyone really cares about is growth and profitability, right? How does capital structure play into those ultimate goals?
It plays a massive role in both. Sustainable growth and solid profitability are what signal a healthy company to everyone, investors, lenders, even customers. And capital structure decisions ripple through the calculations for both.
Let's take growth first. How do we measure it, and how does financing affect it?
A key measure is the sustainable growth rate. How fast can the company grow its earnings using its own internally generated funds? It depends on two things: how profitable the company is, say return on assets or ROA, and how much of its profit it reinvests back into the business versus paying out as dividends, the retention rate.
Okay, so profitability times retention rate. Is that the growth rate?
Almost. The formula is a bit more complex, to be precise. Growth rate, ROA retention rate, 1 ROA retention rate. The retention rate is just 1 minus the dividend payout ratio.
Got it. Let's use that example. ROA is 7.5%, and the company pays out 40% of earnings as dividends.
So the retention rate is 100%, 40% or 0.60% or 0.60.
Okay. Growth, 7.5%. 7.5%, 60%.
Numerator, 0.075, 0.60 is 0.045. Denominator, 1.045, 0.955.
So growth equals 0.045, 0.955, which is about 0.0471 or 4.7%.
Right. That's the rate at which the company can grow organically using its own profits. Now, how does capital structure influence this?
Well, the dividend payout ratio is a capital structure decision, isn't it? How much profit to return to shareholders versus reinvest?
Exactly. A company that uses more debt might feel it needs to retain more earnings to maintain flexibility, lowering the payout ratio and potentially increasing the sustainable growth rate. Or conversely, heavy debt payments might limit funds available for reinvestment.
And profitability itself, ROA or ROE, is affected by debt too, right? Because interest expense reduces net income.
Precisely. Interest expense lowers the numerator, net income in those profitability ratios. But leverage can also magnify return on equity if things go well. So the capital structure choices directly impact both the profitability and the retention components of growth.
It's all connected. What about profitability directly? You mentioned ratios like ROS, ROI, ROA, ROE.
Yes, these are standard measures of how effectively a company is generating profit from its sales, investments, assets, or equity. Higher is generally better.
And the capital structure link, it's mainly through interest expense again.
Primarily, yes. All those ratios ultimately rely on net income or operating income. EBIT. Since interest expense is deducted before net income, a higher debt load directly reduces net income, which tends to lower ROS, ROA, and ROE, all else being equal.
So more debt can make the company look less profitable on paper, even if its operations are strong.
It can, based on those specific ratios. It highlights the importance of looking beyond just one number and understanding the drivers behind profitability, including the impact of financing choices. Dividend payments also reduce assets and equity, indirectly affecting ROA and ROE as well.
Okay, this leads nicely into the concept of leverage itself. We've touched on it, but let's define it clearly.
Leverage is a powerful concept. It's essentially using fixed costs to amplify potential returns. Think of a lever physically multiplying force. Financial leverage uses fixed financial costs, like interest, or fixed operating costs to magnify profits or losses.
Magnifies both ways. That sounds risky.
It absolutely is. Leverage increases variability and therefore risk. And there are two main types we need to distinguish: operating leverage and financial leverage.
Okay, operating leverage first. What's that about? Fixed operating costs.
Exactly. It's about the company's cost structure and its actual operations. How much of its costs are fixed, like rent, salaries from permanent staff, depreciation on machinery, versus variable, like raw materials per unit produced, hourly wages for production workers.
So a company with a big automated factory would have high operating leverage. Lots of fixed depreciation and maintenance.
Precisely. Capital-intensive industries, manufacturing, airlines, utilities typically have high operating leverage, whereas a consulting firm, where the main cost is salaries that might vary with workload, would have lower operating leverage.
What are the implications of high operating leverage?
Well, first, you have a high break-in point. You need to sell a lot just to cover those large fixed costs.
Okay.
But once you pass that break-even point, profits can increase dramatically with each additional sale. Why? Because the fixed costs are covered, and the variable costs per unit are relatively small. A large chunk of the revenue from extra sales drops straight to operating income, EBIT,
So it magnifies profits on the upside.
but also magnifies losses on the downside if sales fall below break-even. High operating leverage means greater business risk, but also greater potential operating profitability if sales are strong.
Can you give an example?
Yeah, the source mentioned Pat Jones' company. A 5% increase in sales resulted in a huge 21% increase in EBIT. A competitor saw only a 10% EBIT increase from the same 5% sales bump.
So Jones's company clearly has higher operating leverage. More fixed costs, but bigger payoff when sales rise.
That's the signature effect.
Okay, so that's operating leverage, fixed costs in operations. What's financial leverage?
Financial leverage is about the financing mix. It's the degree to which a company uses debt with its fixed interest costs rather than equity to fund its assets.
So fixed costs again, but this time it's fixed financing costs, the interest payment.
Exactly. Equity doesn't have those mandatory fixed payments, which is the key distinction here.
What are the implications? Similar to operating leverage.
Very similar in effect, but it works on profits after operating income. A company with high financial leverage needs enough EBIT to cover its fixed interest payments.
Okay, cover the interest first.
Right. But once that interest is covered, any additional EBIT flows much more powerfully down to net income and, importantly, to earnings per share, EPS, because the number of shares hasn't increased like it would with equity financing.
So just like operating leverage magnifies EBIT changes, financial leverage magnifies changes in EBIT into even larger changes in EPS.
You got it. Small changes in operating performance can lead to big swings in shareholder returns, EPS, which is great when EBIT is rising.
But potentially disastrous if EBIT falls and the company struggles to cover interest payments. Higher risk of bankruptcy again.
Absolutely. And it can make it harder to borrow more money in the future if you're already heavily leveraged.
That example of a 21% EBIT increase leading to a 42% EPS increase really drives it home. Debt doubled the impact on shareholder earnings.
It shows the power of financial leverage. If they'd used equity instead, EPS would likely have risen much less, or even fallen due to dilution. So financial leverage boosts potential returns, but definitely amps up the financial risk. It's that double-edged sword again.
Definitely. So if debt adds risk, but also potentially value through this leverage and the tax shield, how do we think about the overall value of a company with debt versus one without?
That's a fundamental valuation question. We distinguish between a levered firm, one with debt, and a hypothetical unlevered firm, equity only.
Okay.
The fascinating insight, largely from the work of Modigliani and Meller, though with modifications for taxes, is that debt adds value primarily because of the tax shield.
The tax savings on interest payments.
Exactly. Those tax savings are real cash flow that goes back to the firm rather than to the government. This extra cash flow increases the total value available to all the company's investors, debt holders and equity holders combined.
Is there a way to quantify that extra value from the tax shield?
There is, under certain assumptions like permanent debt. The value of a levered firm is equal to the value it would have if it had no debt, the unlevered value, plus the present value of all future interest tax savings.
Present value of the tax savings.
Mhm.
How do we calculate that?
It simplifies quite nicely. The present value of the tax shield is just the corporate tax rate, T, multiplied by the total amount of debt.
Yeah.
So value levered, value unlevered, plus TD.
Value increases directly with the amount of debt and the tax rate.
Correct. The tax shield directly adds value. Let's use that final example. Unlevered firm value is $130 million. The company takes on $25 million in debt. Tax rate is 30%.
Okay. Value of tax shield equals TD equals 30%, $25 million.
0.30 times $25 million is $7.5 million.
So the value of the levered firm should be the unlevered value plus that tax shield value, $130 million plus $7.5 million.
Equals $137.5 million.
Wow. So just by adding debt, the company's total value increased by $7.5 million purely because of the tax savings.
That's the power of the debt tax shield. It's a major reason why most companies use at least some debt in their capital structure. It structurally increases the firm's value up to that point where the costs of financial distress start to outweigh the tax benefits.
That really ties it all together. The costs, the risks, the benefits. It all impacts value.
It's the core of corporate finance strategy.
Okay, amazing. Let's try to wrap this up and pull out the key threads. We've been on quite a journey here. We started with the basics. Capital structure is the mix of debt and equity a company uses. We saw debt is borrowed money with fixed payments and a tax advantage, while equity is ownership with more flexibility but higher risk for investors in a downturn.
Right, and we unpacked all the different types, from short-term notes and commercial paper to long-term debentures, mortgage bonds, and even leases acting like debt, plus preferred versus common stock on the equity side.
Then we got into the cost. Calculating the weighted average cost of capital, WACC, that crucial hurdle rate. We saw how it blends the after-tax cost of debt with the costs of preferred and common equity, weighted by their proportions.
And the challenge of estimating the cost of equity using methods like CAPM, DCF, and BYRP, highlighting the opportunity cost concept.
Which all led to the idea of an optimal capital structure, that magic mix that minimizes WACC and maximizes firm value. A balancing act between the cheapness of debt, tax shield, and the rising risk that comes with too much leverage.
We also touched on how capital structure influences asset structure and how lenders use covenants to manage their risk, especially with highly leveraged firms.
And finally, the powerful concepts of operating leverage, fixed operating costs amplifying EBIT, and financial leverage, fixed financing costs amplifying EPS, and how that debt tax shield explicitly adds value to the firm.
It really paints a picture of capital structure not as a static accounting number, but as a dynamic strategic choice with profound consequences.
Absolutely. So if we connect this all back to you, the listener, it really does raise some important questions, doesn't it?
It really should. Now that you've got these fundamental building blocks under your belt, debt, equity, WACC, leverage, the tax shield, how might you look differently at the next company balance sheet you see? Whether it's a blue chip stock you own or maybe a startup you're curious about. What does their particular mix of debt and equity, their capital structure, tell you about their strategy? About how much risk they're willing to take? About their potential for future growth?
Yeah, it adds a whole new dimension to understanding a business.
And maybe even beyond that, how can understanding these concepts of financing, risk, and return help you in your own financial life? Whether you're running a small business or just managing personal finances, the principles often apply. It's about making informed choices.
That's a great thought to leave everyone with. It really does empower you to look deeper. Well, that wraps up another deep dive. We covered a lot of ground, but hopefully you feel a bit more comfortable navigating the world of capital structure now.
Mm,
Maybe even had a few aha moments along the way.
hope so.
Keep that curiosity burning, keep asking questions, and we'll catch you on the next deep dive.